Morning, 1st of June. Beautiful day out here in UK, nice and hot. Birds are chirping, sun is shining, and yeah, lovely stuff indeed. 3 days of hot weather. Take your blessings, United Kingdom citizens. Yes. So anyway, I just found out Arthur Hayes has dropped some new fire, so let's have a little dig into it. Always information packed, lots of good stuff that comes from his brain, and he is so kind to share it with us. And what have we kind of learned so far, right? It's all kind of really about the Fed balance sheet. Kind of simplify all your investment decisions into one metric to watch, right? The Fed balance sheet, and everything is getting wrecked. Everything is getting wrecked against their balance sheet, even though it may be going up nominally. It's not outperforming, apart from Bitcoin, that is, right? Bitcoin is the only asset in the world that's actually keeping pace with the federal balance assets, right? But also bitch stomping it. Yeah, it's just not beat around the bush. It's bitch stomping the Fed M2, right? And how long will that continue? We don't know. But as Wall Street professionals will kind of, look at past performance, they will ape in, right? And they have been aping in, and they've probably been buying the stip. So let's get into Arthur's latest fire. Okay. So this is from 27th of May. It's a few days old, so I've been lagging. So fire, blast, off, go. Some sort of code, right? So blast off, go. It's time to go. Personal views of the author should not form the basis for making investment decisions, nor be construed as a recommendation or advice to engage in investment transactions. La-di-da-di-da. For those of you who have a Bloomberg terminal, run far blast index go brackets. This is the index that outputs the US Federal Reserve's balance sheet in millions of USD updated weekly. Ew, interesting. I keep droning on about this, but this number and its trajectory is the only thing that matters. Boom, there you go. If you have confidence that the Fed balance sheet will rise exponentially from today's levels, then short-term wobbles in the crypto markets become immaterial. To be clear, there are two things that matter to my overall bullishness on the macro cryptocurrency market cap. The US government will begin to engage in nominal GDP targeting. Ooh, I did not know that. I've been calling for this for a long time. If you really want to simplify, if you were to run a central bank, nominal GDP is what you should be targeting. Financed by the Fed purchasing treasury bills, notes, and bonds, but not exponential. Just keep it positive 3-4%, right? Therefore, the Fed's balance sheet will be higher than today. Decentralized finance, DeFi, will aggressively disintermediate many rent-seeking activities performed by centralized financial service institutions. Yeah, I had this idea. I think I shared this thought yesterday. Just savings due to cheaper fees and more inclusiveness will flow to the end user and those who hold the tokens. The hypergrowth for 0.1 provides the push to accelerate 0.2. The hypergrowth for 0.1 provides the push to accelerate DeFi. Hope you have some DeFi exposure. I do. Up the yin yang. Self-perpetuation and growth are the two universal constants when evaluating the potential actions of organisms or a civilization. Self-perpetuation and growth. Boom, boom. Can't find nature, baby. Which is a collection of humans. Most modern societies have an underlying assumption of infinite growth. Look no further than how we price a stock. A stock's value is the discounted stream of all future cash flows. The terminal value assumes the company continues to exist and grow forever. This is obviously empirically false, but we plug it into our fancy model anyway. Therefore, my overarching assumption is that growth is preferred and assumed. The question is cost. There are various ways to pay for growth. Since we are not at the inside the banking cartels, access to the free money, we have got to pay for this growth, right? There are various ways to pay for growth, and one of the most effective on a national level is nominal GDP, targeting paid for with borrowed money. To fully understand why I am so confident that the Fed's balance sheet might be 10x higher. Whoa, 10x higher in short order. We're at 8 trillion right now. He's talking about 80 trillion balance sheet over the coming decade, 3 decades. I will compare how America dealt with the aftermath of WW2. I've been calling COVID as our World War III, to how it will deal with the aftermath of the World War. There we go, on COVID-19. I do love that we kind of share similar thoughts, but he kind of puts it down better than I can ever do. The political and economic conundrum is always, how does a nation continue to grow after a destructive crisis? This is the Crypto Trader Digest, but I spend a lot of time talking about American monetary policy instead of the fundamental merits of a decentralized monetary and financial system over the current parasitic centralized system that reigns supreme. We live in a USD world. He keeps saying that, which is true, until the Chinese yuan is confirmed as number one. It is plain to anyone who reads Satoshi's white paper that the 2008 financial crisis and the response of all major central banks was one reason why Satoshi believes something better could be created. Therefore, an appreciation of and confidence in the trajectory of the most important financial institution globally, the US Federal Reserve, will allow any speculator to shrug off being down 30 to 50% on the day. Because they know that in less than 10 years, the tsunami of money printing will take the crypto complex's market cap to unimaginable levels. Boom, boom, boom. What are we at now? 1.6 trillion? Times that by 20, 30, $50 trillion crypto market cap. Decade, 15 years, 20 years out. Why not? If the Fed balance sheet is going to go up 10x, why not the crypto market go up 10x and outperform that 10x? Of course. Before we go back in time to 1939, check this. Due to the gargantuan US fiscal stimulus enacted to fight COVID, federal net outlays represented 31% of 2020 GDP. I kind of knew that number. It's shocking, isn't it? That makes the US government as a standalone entity the third largest economy as measured by 2020 GDP globally. I did not know that, but it makes sense. Complete sense. I think the US GDP, that's not the Fed GDP that he's kind of measuring, is 20 something trillion. UK is about 2 point something, right? Something like that. Just behind the US private sector and China. Boom, boom, boom. Yeah, if the US Federal Reserve is bigger entity than the US private sector, it's getting to the point. So a banana republic, right, is when economy relies on one product or commodity, say Barbados or Jamaica grows bananas or whatever, and that it represents more than 20% of their actual economy. You kind of call it a banana republic, right? Because a shock to that growing season of bananas wrecks the whole economy, right? Boom, boom, boom. The great thing about any large centralized government is they collect a lot of stats. Yeah, the St. Louis Fed has some great stats. I'm just gonna close my window here. Sorry for the noise. You can't imagine what you don't measure. You can't manage what you don't measure. Yes, if you worked in corporate, you have to create a lot of data, stats, modeling, right? Therefore, the richness of stats during and after WW2 allows anyone with an internet connection to connect the dots. Let me too long didn't read this essay for the TikTokers. I know I probably lost you at my first sentence, but I hope by now your attention span can spare 2 minutes. You should pay attention. What happened post World War II? In order to pay for World War II, this is key, really, really key, and WW1, and how, Japan, Germany were kind of flattened and rebuilt, right? And a large debt was placed on the United Kingdom, etc., etc. They do that intentionally, and they're doing it now with the United States. China is placing a huge debt load on Western economies, and they are just running away, right? The US government borrowed money in order to pay for WW2. In order to keep its cost of funds down, the Fed bought bonds in a large enough quantity. If they created a crisis, imagine if they funded both sides of the army, the Nazis and the Allied forces, with their Fugazi money, and then on the back end, they bought the bonds in a large enough quantity to fix the price of money. These bankers are, what can you say about them? That hasn't already been said. The long end was fixed at no greater than 2.5%. So they managed the yield curve, right? As a result, the Fed's balance sheet rose from 11x from 1939 to 1946. Wow, that's an interesting stat. So that's why he's getting the 10x from now, right? At its peak, the US debt to GDP ratio reached 110%. In order to inflate away, here we go, this is key. In order to inflate away the debt incurred to win the war, the Fed continued fixing the price of the Treasury curve until the Monetary Accord of 1951. Yeah, 1951. What happened in 1951? Oh no, 1944 or 45 was Bretton Woods, right? When the Fed regained its independence from the Treasury. No interference from meddling politicians. The Treasury should be the mint of the coin of the nation, right? Unfortunately, the plebs were forbidden to privately own gold. Yes. Is it Roosevelt? 1933. So they suffered severe negative interest rates and high inflation. They had nowhere to go but government bonds and equities. By 1951, Warren Buffett started his investment career around 40s, right? 40s and 50s. So he was a beneficiary of all this. By 1951, the US government successfully delivered its balance sheet. Successfully delivered its balance sheet, dropping the debt GDP ratio from 110% to 70%. Now the Fed could allow the free market to operate once more in the US Treasury market. Interesting. So if the debt GDP ratio is higher than 100%, a normal investor would look at it and say, nah, I'll put my dollars elsewhere. But at 70%, the bond rating increases, right? Interesting. What is happening post-COVID? In 2020, the war on COVID caused US GDP to drop the most since World War II. Thank you, China. In response, and the CCP. In response, the US government, run by the Republicans, spent the most money in aggregate terms in US history. The Fed, while not engaging explicit price fixing of the Treasury curve, bought 55% of all treasuries issued in 2020. So they're managing the curve again, right? This resulted in the balance sheet growing 76% in 2020. US debt to GDP reached an all-time high of 130% by the end of 2020. So now they've got the same issue where they have to deflate the debt away. The Democrats were elected, or were they? And just like the Republicans, swiftly enacted a few $1 trillion spending bills and promised to do much, much more. The US now is a dual deficit country. It spends more than it receives in taxes, fiscal deficit, right? It collects through the IRS, and it spends through the Senate, the Treasury, right? So it's negative, right? And it imports more than it exports. Negative capital account. Imports more than it exports. Well, that's been like that for ages, right? If you take all your manufacturing and export it to foreign countries, China, yeah. US politicians in both parties are vocal that the government must aggressively. There's no reason why Apple can't build its phones in California. It used to, right? No need for Foxconn. US politicians in both parties are vocal. Most US Americans would actually willingly pay extra, what, 10, 20, 30, 40, $50 for their new shiny iPhone if it was US built, right? So why didn't they do that? I was in Northern California when they shut down, plants, Apple plants there. US politicians of both parties are vocal that the government must aggressively expand fiscal spending to right the wrongs of the past and ensure labor is protected in the aftermath of COVID. Foreigners are not waiting around to watch their $7 trillion of US treasuries get decimated, and on a net basis only bought 8% of treasuries issued in 2020 versus 42% of all treasuries issued from 2002 to 2019. Previous to 2002, banks would buy treasury bonds, pensions would buy treasury bonds, so they still do, but they got overwhelmed, and we offshored the buying of this paper to like China, Japan, and they stopped buying now, right? The only political acceptable option is aggressive fiscal spending paid for by Fed money printing. Thankfully, in 2021, we have the crypto capital markets, which are not a target for some government agency or central bank. While the tens of trillions of dollars created by the Fed will not all flow into crypto, some of it will. And because crypto is unencumbered, it can rise to a level that allows holders to maintain purchasing power in the face of monetary inflation. My research assistant and I have worked diligently to create informative charts to bring life to this hypothesis. Strap in, have your drink or mug of kombucha handy, and let's fall in love with macroeconomic stats. When you finish, I hope you have more confidence in your crypto portfolio, right? And maybe you buy the dip. War equals inflation. That's why perpetual wars. War is a terrible thing. It's even worse when you, as a taxpayer, have to pay for it directly. That is why governments would rather resort to the stealth tax of inflation than aggressively raise taxes to pay for war. 1913 income tax was a temporary bill to fund World War I. Was it 1913 they introduced it? So I think on the books it's still as listed as a temporary income tax, right? It's temporary bill. The population might turn out to be a bit too pacifist, leading to a chorus of objections regarding the use of their tax dollars. While certain taxes were raised to pay for Americans' participation in WW2, like all governments before them and after, they chose to borrow money to pay for the war. I will draw heavily on a Federal Bank of New York staff report entitled Managing the Treasury Yield Curve in the 1940s, published in February 2020. Wow, okay. And okay, it's drawing direct quotes in italics. When the US decided to formally enter the war after Pearl Harbor, I think they planned it, they had to figure out how to pay for the massive expenditures needed to fight. Remember, the government spends and the Treasury pays for it. Government spends and the Treasury pays for it by selling bonds. Selling fake paper. As always, you want to pay as little interest as possible when borrowing money. Think of your car payment, right? Mortgage, right? The Treasury politely requested that the Fed create excess banking reserves for the sole purpose of supporting their bond issuance. This is from the report. The FOMC, Federal Open Market Committee, made no attempt to manage either the level of reserves or the level of interest rate. Open market operations were limited to maintaining an orderly market for Treasury securities. Securities, isn't it interesting? They denote the Treasury securities, which is what security is relying on the work of others, right? And typically involving maturity, so it's not money. You're relying on people, right? In a security. And typically involved maturities, switches rather than outright purchases or sales. But then the Treasury dictated the Fed helped them fix the price of money because general population wasn't hip to receive such low rates to help the US government finance the war effort. So back then, so you got a population of mainly Europeans who migrated or emigrated to the United States, right? Kind of abandoning their homelands, right? And there was a big, they weren't really keen to enter any of these world wars. Definitely not. They were kind of the opinion, let Europeans sort themselves out, even though they are Europeans ancestrally, right? So they wanted to stay USA to be a neutral place, kind of a safe haven away from world's affairs, right? But the Fed and the Treasury and the US war machine turned the United States into the world's police, right? Often instigating a lot of the stuff that goes on. The 3/8% bill rate did not command similarly widespread support. That's why all news outlets was all propaganda to support their, the plans, right? Prior to the first big wartime financing, the May 1942 offering of $900 million of 2.5% 25-year bonds, Treasury officials pressed for a commitment from the Federal Open Market Committee to maintain an ample quantity of excess reserves. They wanted to be able to rely on the pressure of excess reserves to bolster demand for the bonds. Editor, very important. Footnote. Marina Eccles, the chairman of the Board of Governors, has noted several months earlier that if substantially the present methods of financing were continued, it would be necessary to create a large volume of excess reserves for the purpose of placing the banks under pressure to purchase government securities. Minutes of the FOMC, March 2nd, 1942. Translation: the Treasury wants to borrow money too cheap, and you are dragging us. The Fed kicking and screaming into a policy where we have to buy an unlimited amount of bonds to fix the price where you, the Treasury, desire. The result is that our balance sheet will explode. Well, I love the way he talks. Keep talking, Arthur. System open market account. What? It's 2 trillion? What the? 2 billion. 2 billion to 22 billion, a 10x. So it's made of T-bills, certificates, T-notes, bonds. The Fed SOMA account, I don't know what that means. Fed SOMA account, balance ballooned over 10x from 1939 to 1946 as it performed its patriotic duty to fix the price of money at the behest of the Treasury. Most importantly, the long bonds rate were fixed. Price fixing, right? At 2.5%. Why don't you let the market decide? Boom. If the market decided it would be what? Super low. The chart, or super high, yeah. The more risky the bond, the higher the rate. The yield has to be to attract investors to take the risk, the punt of default, right? That's the way it works. The lower the rate, the safer the bond, the debt. This chart clearly shows that the general public did not want to lend. You are lending your money to the government on lots of levels, to US government at artificially depressed prices. Unfortunately, early in the 1930s, President Roosevelt outlawed the private ownership of gold. The traditional inflation hedge of thousands of millennia was not available. Well, isn't that convenient? Real interest rates. This is the main driver of gold and should be if gold is allowed to freely trade, right? Anytime real interest rates are in the negative zones, gold should be like going ballistic. Gold should be going ballistic, but now you can't buy it. Now you can't buy it. Now you can't buy it. I crudely define the real interest rate as the long bond rate. Okay. I crudely define the real interest rate as the long bond rate minus year-over-year nominal GDP growth. That's a good way to do it. That's a good way to do it. Any government can juice economic activity by printing money. Overall, I'm a fan of monetary inflation. You want more cookies in the cookie jar, right? You want more cookies in the cookie jar to keep the players around the cookie jar to continue to hustle, to go about your daily business, to work, grind, innovate, invent. If they see the cookie jar getting depleted, they will stop doing their activities, of working, and will start hoarding the cookies, right? So you want inflation. You do want inflation. If it pays a lower interest rate than the GDP growth created via debt financing, then it profits, while holders of the public debt suffer. Every single economic miracle of the Asian tigers in the post-World War II era owes its success to financially repressing savers. Boom, there we go. And redirecting cheap financing to heavy industry. Boom, boom, boom. That is how China was able to grow so quickly from 1980 to the present. See, hoarding of capital is not good for economies. There you go. Finally got it. The tough part is winning yourself of the performance enhancer steroids of national debt. How do you get yourself off it once you're on it? Once you're used to juicing. As we can see, anyone saving money via deposits in the banking system or holding US treasuries got eviscerated. With deeply negative saving rates so that the US could afford war, there really wasn't much you could do. Either you put your savings in the bank or bought bonds. The equities market was still recovering from the Great Depression. From 1939 to 1951, the Dow Jones Industrial Average declined 4.6%. Boom. There was no way to escape the great financial repression inflicted on savers. The US population were savers, right, at this point in time, especially post 1929. They only really got into speculation during the 20s, right? The Roaring 20s. So they pulled you in and they pulled the rug. They brought you in to the casino and then rug pulled you. Isn't that nice, bankers? So they could bring about a social programs, right? Get you into the World War II, right? These all these global events are interrelated and connected over many years. It's a long daisy chain. This monetary inflation did bleed over into real goods and services. The CPI index nearly doubled from 1939 to 1951 again. Again, no escape. I detest the stock to flow ratio, but it's so popular that I'll shut the fuck up and use it as my analysis. Yeah, stock to flow is fucking bullshit, but it's all right. What else? It's a popular thing, so whatever. The chart illustrates that America's balance sheet was sacrificed in order to participate in the war. Yeah, yeah, that's this, right? Even after hostilities ended, the Fed continued to fix the price of money. The US emerged with its physical infrastructure unscathed. Isn't that nice? And rebuilt Europe. GDP growth surged, but rates did not. The result was a deleveraging of the government's balance sheet. That's cool, isn't it? The Fed finally regained its independence in 1951. They did their patriotic duty and were allowed to pursue. Oh, so nice of them. And they were allowed to pursue an independent monetary policy. The impasse continued until mid-Feb 1951, when Snyder went into the hospital and left Assistant Secretary William McChesney Martin to negotiate what has become known as the Treasury Federal Reserve Accord late on Saturday. It was always on the weekend, midnight. March 3rd, 1951. Treasury and Federal Reserve officials announced they had reached full accord with respect to debt management and monetary policies to be pursued in furthering their common purposes to assure the successful financing of the government's requirements and at the same time to minimize monetization of the public debt. Alan Metzer concludes that the accord ended 10 years of inflexible, so locked in interest rate, right? Price fixing, and was a major achievement for the country. I love this quote. Alan Meltzer concludes that the accord ended 10 years of inflexible interest rates and was a major achievement for the country. Translation: we artificially depressed the price of money to help the government pay for the war using a stealth inflation tax. Luckily, America possessed the innate physical and natural capital to pursue such a blatantly inflationary monetary policy without any social upheavals. That is because America had a very robust domestic manufacturing base, could feed itself. Can America feed itself now? And had the industrial commodities necessary domestically to produce real goods. They still got the commodities. They don't have the manufacturing base. Or the people willing to work blue collar jobs. Once you get highly educated, that kind of thing, those kind of jobs seem beneath you, even though ask a plumber how much money they make. They make bank. People in making American cars back in the day used to make bank as well. Remember that? Most countries that pursue similar war payments devolve into social chaos as the expansion of the money supply leads to crippling inflation, Venezuela, etc., in real goods and services. That is because most nations are not so well endowed for a giant, big ding dong by Mother Nature. The UK only just paid off its WW2 debt to America in 2006. It took them almost 6 decades to fully discharge the cost of war. It took America 5 years, from 1946 to 1951, to significantly inflate away the cost of the war. That is the beauty of being the world's reserve currency. Help a brother out, why don't you? Nah, F you, UK. I thought we had a special relationship. Only when we need it to. The key lessons to remember as we transition into the present are the following. To participate in the war is expensive, and governments would rather tax indirectly via inflation than directly via taxes on wages and capital. The central bank's independence is a chimera. When Cool Car by Bugatti, right? No, Chimera, that's the TVR. Sorry. I'm thinking of the Chiron. When domestic agendas require central banks to print money to cheapen borrow costs of their government. The central bank will always follow orders. Who's giving orders? You decide. I think it's always the people who own the bank, the guys who don't appear on TV. In order to delever the federal government's balance sheet, the government must be able to borrow cheaper than the nominal GDP growth the expansion of debt creates. The release valve is the balance sheet of the central bank because it must rise. The release valve is the balance sheet of the central bank. Crypto is our new release valve for the people because it must rise as high as needed in order to absorb the amount of government debt the public refuses to purchase at the government's artificially depressed interest rate on offer. This monetary inflation will manifest itself in financial assets and real goods. The COVID-19 forever war. All right, I've been going for half now. I'm going to break this up in 30-minute chunks, but there's some more charts. Yeah, this is a long one. So yeah, I'm gonna break this up in chunks. Maybe 3-4 parts. So all right, people. End of part 1.